Most traders focus on charts and headlines, but totally ignore one of the biggest forces in the markets, which is bonds and yields. Bonds don't just affect governments and banks, they have influence throughout stocks, currencies, commodities, even the crypto markets. And if you don't understand bonds and yields, you are essentially trading blind. In this video, I'm going to take you from having zero understanding of bonds to having a full grasp on what they are, how they work, and how they drive the global financial markets. Bonds exist in every major economy. Throughout this video, we will be using the US as reference points. So in the US, you have treasuries. In the UK, we have gilts. And in Japan, you have Japanese government bonds, also known as JGBs. And Germany has bunds. The concepts are all the same. They are just loans issued by governments to raise money. Even if you trade Forex and gold, yields are what move those markets the most. At its core, a bond is simply a loan. When the US government needs money for infrastructure, defense, to cover deficits, or general spending, it borrows money by issuing bonds. When an investor decides to buy the bond, they're essentially lending the government money, and for buying the bond, you get two things in return. First of which is what's called a coupon payment. Payments are essentially just interest, like what you would pay on a mortgage or a general loan you take from the bank. And secondly, the original amount called principal, and this is returned at the end of a bond's life, and this is what we call maturity. This makes bonds extremely safe, especially US treasuries, because the US government has never defaulted on its debt. Yet, anyway. A coupon payment is a fixed dollar amount paid to the investor. For example, a $1,000 bond with a 5% coupon returns the investor $50 a year. Most US bonds will pay twice a year, meaning you will get $25 every 6 months. Now this never changes, which is why bonds are perceived as safe and predictable. No matter what happens in the markets, the coupon will stay the same, but the price of the bond may change. Even though the coupon is fixed, bonds are traded on the open market every day, just like stocks. Every movement in price is based on supply and demand. If investors are buying, the bond goes up. If investors are selling, the bond goes down. And this is where the concept of yield comes in. Yield is the bond's return relative to the bond's price. So when a bond's price goes up, the yield goes down. Or when a bond's price goes down, the yield goes up. This relationship is the foundation of how bond markets work. Let's just do a quick example. A $1,000 bond with a $50 coupon equates to a 5% yield. If the bond's price rises to $1,100, that same $50 coupon now equates to 4.5% yield. Price goes up, yield comes down. Price goes down, yield comes up. It's an inverse relationship. Investors don't just buy bonds with any yield. They demand a return that compensates them for the risk they are taking. The main risks are as follows. If inflation is high, the dollars investors receive in the future will buy less. To make up for this, they demand a higher yield. Secondly, default risk. Some governments or companies might fail to repay their debts. US treasuries are considered virtually risk-free, but bonds from other countries or corporations carry higher risk, so they must offer higher yields. Opportunity cost. If the Federal Reserve raises interest rates, investors can earn more elsewhere, like in cash savings. For bonds to stay attractive, yields must rise to compete. In short, higher risk or better alternatives mean investors demand higher yields. Yields are like a real-time poll of investor expectations. If yields are rising, it means investors expect strong growth, rising inflation, or tighter central bank policy. Falling yields mean investors expect weak growth, deflation, or rate cuts ahead. Here's the key. Yields usually move before central banks. If traders expect the Federal Reserve to cut rates next month, bond yields will start dropping now, before the Fed even makes an announcement. For traders, this information is incredibly valuable. Higher yields usually strengthen a currency, especially the US dollar, as investors chase higher returns. Lower yields tend to weaken the dollar, boost gold, and support tech stocks by lowering borrowing costs. This is why yields are one of the most powerful leading indicators for Forex, stocks, and commodities. The yield curve is spoken about a lot, and that's because it shows the yield of bonds with different maturities, like the 2-year, 10-year, and 30-year. In a healthy economy, the curve should slope upwards, meaning longer-term bonds have higher yields. A flat curve can signal uncertainty. In an inverted curve, when short-term yields are higher than long-term yields, a classic warning sign of recession. Traders especially watch the 2 and 10-year spread, which reflects market expectations for growth and rate cuts. So let's take a real-world example. Right now, the US economy is facing two conflicting forces: the labor market weakening, which pushes the Fed to cut rates, and sticky inflation, which prevents the Fed from aggressively cutting rates. The bond market very clearly reflects this. Short-term yields have dropped sharply as traders price in immediate rate cuts, and long-term yields haven't fallen too sharply due to inflation concerns. And this creates a steepening curve, a signal that rate cuts are coming now, but inflation and debt remain concerns later. So here's how to track yields in your trading. Follow the 2 and 10-year yields daily. Watch for big moves after data releases like CPI, NFP, and Fed meetings. Track the 2 and 10-year spread for recession signals. And always remember, yields move before markets and central banks. If you master reading yields, you'll see trades before most traders even know what's happening. Bonds and yields are the heartbeats of the financial markets. Once you understand them, you stop reacting to noise and start seeing the larger picture. If you want to learn more about bonds and yields and see how professional traders use them on a daily basis, you can join my Discord, learn from me, and trade side by side and follow every position I take. There's a link to my Discord in the description. Please drop a like and subscribe. It does help me out a lot and I do appreciate it. Thank you very much for watching. Stay safe and don't get margin called.